Hi everyone, and welcome to the Cleaves dry bulk webinar. Today, Joakim will take you through the highlights of our latest dry bulk segment report, which of course can be downloaded for free from our website, cleaves.no. And after that, we will have a Q&A session. While he's going through the report, you can send in your questions in the Q&A tab, which you can see in the bottom of the screen. If you see that someone else has asked a question you're also interested in, you can like the question, and at the end, I will prioritize the questions with the most likes. Joakim, the floor is yours.
Thank you, Peter Mikael. Yeah, for many of you maybe have not met our newest addition yet, Peter Mikael. He joined us last year and is doing a tremendous job. Okay, let's start on the presentation. So welcome to our dry bulk shipping webinar, which we have decided to call Retreat Hell, We Just Got Here. So many of you might know the story of the American major Lloyd Williams arriving in France in 1918 with his Marine Corps. He was attacking the Bellevue Woods, where he encountered some French troops retreating from the German onslaught, and he was advised to retreat, and he famously answered, "Retreat, hell, we just got here." Whereupon he and his Marines won the battle a few days later and routed the Germans. So to put that into dry bulk context, it's kind of the feeling we have where we are now. Share prices have risen a lot over the past few months. They have moved ahead of NAV. The question now is basically, will prices come down again, or will asset prices follow the price movement upwards? To answer that question, we agree with Williams that we would like to hold on to recent gains and do not want to retreat at this point. So just a executive summary. First, we will go through the market fundamentals. Main theme is the all-time low order book. And then we will have a walkthrough of capital flows and the current pricing and kind of analyze whether or what will happen to prices and asset prices. And then we'll go through briefly our top stock picks at the end. Okay, starting off with the short-term outlook. So right now we are at the seasonal low of the year. I would say Capesize spot rates have performed as expected, although slightly better start to the year than we had expected, but right now almost down to operational costs. And as many of you know, we are now in the Chinese New Year holiday. So this is seasonally the low point of the year. In addition to Chinese New Year celebrations, we have the usual Brazilian rainy season, which has been very light so far this year. So that has been one of the reasons Capes have been performing so well. And we also have the Australian cyclone season, which is nearing its end, and it's also been quite mild. So against that backdrop, we have seen the smaller segments doing very well, haven't come down anything so far this year. So that's been a very positive surprise. And I think that is spurred on by Chinese demand for coal and agricultural products. So that's kind of the main reason why we have seen the smaller vessels outperform the bigger vessels so far this year. And looking at the top right graph, February is usually the month where we have the lowest spot rates on average, going back to the 1990s or so. And going forward, usually the smaller vessels outperform the bigger vessels from an increase in agricultural products. And I think this year we will see this play out maybe a little bit even more, because Chinese demand for agricultural products is quite high. We hear estimates revisions so across the board for Chinese imports. So So that story is looking very good. For the Capes, I think it will be a bit touch and go for the next few months. Usually it's a bit sluggish until September, October. But that said, I think this year, post-COVID year, this is the year of the recovery. I think all bets are off, and the year could play out very differently than a normal year. So let's see how it plays out. Anyways, we have strong support from Brazilian iron ore exports. They are moving up nicely, and we expect a strong demand or strong growth in export volumes in 2019 versus 2020. They are slowly recovering from the dam collapse in January 2019. Also, we have support from coal. Last year, we saw about 10% decline in ton-mile demand from coal. We think that will recoup somewhat this year. And also minor bulks like alumina and bauxite and all these kind of smaller things. It's expected to grow massively this year. So just kind of the last short-term driver, we talked about it before Christmas, and it's still an issue. That's Chinese coal or ban on Australian coal imports. So on the lower right graph, you can see how it's usually been around 40%. Right now it's down to 8 as of November. I think it's even lower as of December and January. So that ties up a lot of vessels, so that's good. And we're also seeing a lot of imports or rerouting of the traditional trades. So Australian coal going other places, and then coal from other destinations or like Indonesia and South Africa and so on, moving into China. So it's a bit ambiguous whether this is a positive or negative effect. I think it's slightly positive at the moment. So an unwinding of that one could also be interesting to follow, but not potentially a big material impact. Okay, long-term outlook. So our view is kind of consistent. It has been so for many years. So we have always argued since 2018, at least 17 as well, that we have low order book and we expect gradual demand growth more going forward. And then we have had the two setbacks, Black Swan, the dam collapse in 2019, and then of course COVID-19 last year. The story remains intact. It's just been pushed out. And the positive thing is that we have even lower fleet growth now than we had a few years back. So the order book now stands around 6% of the fleet on the water. So that equates to a net fleet growth around 1 to 3% per annum. It's the lowest order book on record. We have records going back to the mid-1990s. So we need very little demand growth to propel fleet utilization into very good territory. So on the bottom right graph, you can kind of see the demand growth, the forecast we have. So 7.7% growth this year, which is a catch-up and recoupment of the lost demand from last year. But thereafter, we expect, I would argue, quite modest demand growth going forward. But it is still enough to outpace fleet growth. And this you can see on the top right graph here. The blue bars are the demand growth, and the gray graphs are supply growth. So you can see from a historical context, even though our demand growth forecast is quite low, it's still enough to outpace fleet growth. So this leads then to improved fleet utilization, and then that again equates to higher asset prices. So we expect asset prices, we have already seen them rise 12% over the past few months. And we expect them to potentially increase another 30% over the next year and 50% over the next 2 years. Usually that 30% asset increase would potentially lead to 100% increase in our share index. But as we will show later, prices have already moved ahead. So part of this lower share price index is due to the catch-up effect of asset prices we expect over the past or in next few months or half a year, 9 months. Just kind of taking a step back, having the holistic view, I think this graph is very educational. It shows how many dollars have been invested in new buildings over the past 20 years. This is, I would say, a good proxy for overall investments in shipping, and also it's important to know that this, of course, is in a period where the fleet has grown over time. So when we kind of show you the absolute numbers here, the relative numbers are even lower when you compare to the total value or total fleet on the water. Anyways, what this shows you is that since 2016, we have had a systemic underinvestment in shipping. I would say maybe besides gas, which is the lower part of the graph, but it's a small part of the overall shipping investment universe. Besides that, we have seen underinvestments in bulkers, in tankers, and also containers. So what this means is it's basically the reason why we have so low order books both in oil tankers and dry bulk, and this kind of lays the foundation for what we believe could be one of the best decades for shipping in a very long time. Obviously, the 2000s were an incredible good decade. I don't expect to see the same kind of numbers, but adjusting for that decade, I think it would be one of the best decades in a very long time. So here, there's a lot of opportunity for the savvy investor. Okay, so that's just show you kind of the underinvestment, the history. This slide aims at showing what is going on at the moment. So you see the dark blue, the black line shows Golden Ocean daily turnover of the share price. It's a 3-month moving average. So it's a proxy for the whole dry bulk segment. So you can see back to the 1999 and 1990s, you kind of have big spike in the turnover around 2014, 15, 16, coinciding with increase in share price. And you see the same pattern each time. And the last cycle we plotted with the blue dotted line, and you see the Golden Ocean share price correlating with the turnover. So what is happening right now? That's the question. And if you look at the dotted line or the box on the right, we have kind of magnified that on the right side. And if you see the green graph, you kind of see the daily turnover in all our dry bulk shares. So you can see it has increased more than 100% over just a few months. So what that tells us is that there is large capital influx coming into dry bulk at the moment. And besides obviously fantastic fundamentals, we also think this is driven by post-pandemic positioning, where investors are kind of, you see, generalist money moving into the segment, trying to do the post-COVID commodity play, positioning themselves. And I think that's a very wise move. But this is what happened whenever we see a lot of generalist money moving into shipping, which by all means is a fairly small market segment or a small sector. So then you suddenly see big movements both in price and in turnover. So moving on to kind of what this means in terms of pricing. Just took a snapshot of our dry bulk share index. and our dry bulk NAV index, just a snapshot since 2016. From our perspective, this kind of feels a lot like the first quarter of 2017. So back then, we obviously, early 2016, there were a lot of concerns around Chinese economy. And that kind of led to weak asset prices, but share prices performed quite well. And you can see they were trading at a large premium to net asset values basically throughout 2016. And then the question kind of, or in the early 2017, we saw share prices move ahead, but we didn't see any movement in asset prices. So the big question then was, like, what's going on? Will prices correct back down, or will net asset values come up and correct that premium pricing? And what we saw then, and we see the similar pattern when you have kind of a share that is trading at a P/NAV 1.5, you print a share, you print $1, and you use, or you print 150, and you use that 150 to buy a ship, but a ship is only worth $1, so you get 1.5 ship. So you kind of, it's accretive for shareholders. So you print at a premium and use your share price as a currency, which is then worth more than any dollar amount would be. So we see the same effect playing out now. We see Starbook doing this, Eagle Bulk is doing this, using their premium share price to buy ships at NAV and printing at above NAV. Last time that led asset prices to rise. Prices stayed pretty much the same, and then suddenly the premium to NAV was gone. We think something similar will happen this time around. From our fundamental research, we showed a few slides back, we expect 30% upside of asset prices, and that's just driven by pure economics. So if we kind of add the effect that people can use their premium pricing and print shares and buy ships without having to raise any capital directly from the market, it's easy to see how this would also move asset prices up and reach our target of 30% within 1 year. So that basically means, looking at it from different perspective, all things point towards one thing, and that is that prices will most likely not come down. It's net asset values that will come up and close the gap before we see another push in prices. And another push in prices could obviously come earlier than expected, given the capital inflow into the market. So it will be interesting to see how it plays out, but we expect it to kind of increase going forward. So just to a kind of last point of view on asset prices, the yellow dot shows you where we are right now in terms of 1 year time charter rates on a 5-year-old Capesize versus the value of a 5-year-old Capesize. So this relationship is historically highly correlated, R squared 92. So if we were just to price up to the historical average today with a 1 year time charter rate around $18,000, we would immediately have an uplift of 18% for Capes, and doing the same exercise for Kamsarmax shows 25% upside, and for Ultramax 29% upside. So just by pricing back to historical averages in the current market we are today would immediately lift asset prices significantly higher. And then obviously our forecast is for within 2 years approximately, we expect the 1 year time charter for Capes to reach around $37,000, $38,000 a day. And that would, yeah, you can look at the graph, I would say maybe for 50% upside on asset price, maybe even more. So it's definitely a significant upside potential, and yet another data point which points in the direction and which will answer our questions, kind of, will we retreat or will we defend our position and move ahead? And the answer is resoundingly, looking at the math, that we will move ahead. Okay. So with all that kind of fundamental background, I would like to briefly touch upon our kind of our topics. So obviously, we advise investors to buy or to invest in dry bulk, either by equities, FFAs, or derivatives, or bonds, or whatever. Our focus is on equities. So on the top right graph, we have plotted our forecast. So this is derived from our models and the implied consensus forecast for the same years. So this is kind of an average over the dry bulk fleet. So you can see for 2021, we are slightly more bullish, but nothing significant. But the interesting impact is for 2022 and 23. And if we are correct in our assumptions, there will obviously be a lot of positive reports coming out from our peers going forward, and that's always positive for share prices. So our topics, 2020 bulkers, we have a 64% upside. The fleet is just top notch. They have Newcastlemaxes, brand new. They have proven an ability to earn or out-earn their Capesize siblings by a lot, and they have, I would say, some of the most investor-friendly policies in dry bulk, where they publish each month what they have achieved, so it's fully transparent, so that you don't get those big jump on the quarterly reports. And they also have a monthly dividend policy. Just very transparent way of dealing with being a public company. Genco Shipping, it's one of the liquid stocks, but for some reason it's highly undervalued compared versus peers. I think it's unfair, but worst case scenario, it stays undervalued, but at least you will have in EV/EBITDA multiple far below peers, and most likely a higher dividend yield than peers, not too far down the road. So that's I would say a good one to pick up. And then Golden Ocean, trading at an unusual discount to peers like Starbulk and Diana. The track record of Golden Ocean since the 1990s is really strong. Investor-friendly policies, and we see a 73% upside to Golden Ocean. What time is it?
It's 5 to.
Okay, so I see we have enough time. I wasn't sure we did have enough time for this slide. So just kind of a fun way to end the presentation. I don't know if you are familiar with Castor Maritime. So I'm not too familiar with the company. They have a few Kamsarmaxes. They have a strong balance sheet, and I think they moved into oil tankers now recently. So it by all means, it seems like a good company positioned to grow at an opportune time in the cycle. So it's been trading around 20 cents for a long time. They even raised capital at the end of December and early January around 20 cents. And that was, they were diluted existing shareholders by about 78%. On our now calculations peg them around 20 cents. So that's all fine. But what happened here is that since January, the share has traded up from 20 cents to 1.7, I think, on Thursday when he made this graph. So that's just immense, and it's 8.5 times net asset values. Kind of what's the rationale here? And obviously there is some Reddit movement, which is the reason behind this, and it's quite baffling how retail investors kind of cooperating through a Reddit type platform can end sending a penny stock up to above $1 billion in daily turnover on Thursday. it's just incredible and really fascinating. Obviously, we kind of think now is the right way to go, but $1 billion. I mean, same day Starbucks daily turnover was $17 million. That's the most liquid dry bulk play. So yeah. So on that note, I think I'll end the slide by saying we would recommend some of the guys on the previous slide if you want exposure. But it's fun to see how things can move sometimes. Okay, so to sum it up, I think fundamentals looking really good. We have had 2 black swans behind us. I think this time is the time. All-time low order book. We need so little demand growth to get this into extremely high earning environment, and we already see capital flows, big capital flows moving into the market. Asset prices are on the rise. Everything feels right. We have gotten far, but again, retreat is not in our vocabulary at this point in time. So we think we will win the battle and also win the next one. Topics: 2020 Bulkers, Genco, and Golden Ocean. And I think with that, I think we will open the floor for a Q&A. And I'll invite Peter Mikael to moderate that Q&A, and I will try to answer as best as I can.
Right. Okay. So we can start with this one. Do you have information about the possible shipping ETF or fund from Cleaves?
Yes. I'm happy that people are asking about this, and we get a lot of questions about it. Obviously, we have a strong platform and a strong track record, but I'm not too eager to say too much before we are in the starting position and or before we start running. So I'll say the same thing I said before Christmas, that we are thinking those lines. We have done a lot of work, and hopefully we will have something to bring to the market within a short amount of time.
Okay, we see Capes spot up 20% today, even though Chinese manufacturing is down due to Chinese New Year. Where does this increase come from, and how do you think Cape spot will develop the next days and weeks?
Okay, it's always hard to kind of predict the near term, but from what I've seen, I mean, Panamaxes are doing quite well. You have seen some Capes picking up Panamax stems, so we kind of pool two Panamax cargoes together, and you take them on board a Cape size. So this is kind of the dynamics you always see in all of shipping. So whether it's a VLCC, Suezmax, or on a Cape Pana, you could take two Panamax coal cargoes, pull them on the Cape size. The only problem, or the main problem, is port restrictions. So the Cape size is obviously deeper in the water and wider and longer, of course. So you can't always go to the same ports, but if you do a coal trade from Eastern Australia to China, you could most likely put that two Panamax cargoes on board one Cape and save some money if the differential between the two are big enough. So I think that's the main reason why we've seen the movements today. And if you look at the FFA curve, it's significantly up. It started to move, I think, Friday. So it wasn't all that unexpected that the sentiment from the FFAs were to move into the physical market. It's usually that way it works. FFAs are leading the physicals. And now with the Chinese New Year almost or over this week, I think the stock exchange is open from Thursday. Mm-hmm. Then we expect activity to pick up, and I think the worst is over for the Capes in the near term, but it's always hard to predict.
Okay. And then you have a target price for a goggle is this adjustable if your TC dry bulk forecast is correct in 2022 and 2023, or is it priced in your target price?
Target price is adjustable if I'm trying to understand. So if the target is adjustable, so I'll try it. If I understand correctly, will our target price change if our dry bulk forecast time charter rates change?
I think he's asking if it's already priced in, maybe.
I would, yeah, okay. So let me just explain how our target prices work. Maybe that's clear. So we have a mathematical generic approach to target pricing. So what we do, for instance, when we change our recommendations from buy to sell, even though the price is unchanged, is that we potentially we roll over into the next year because time has passed. We maybe increase our forward spot rates and asset price forecast. So then forward now becomes higher and EBITDA multiples becomes higher. So that's kind of the dynamics behind the changes in our target prices. And of course, the target prices themselves are derived from a weighted valuation matrix. So we could potentially have 20% weight on current now, 20 on 1 year forward now, 20% on a NAV scenario where we see asset prices increase 25%. We can have 30% weight on EV/EBITDA multiples in 2021, all depending on how we see the cycle developing. The important thing is that although this valuation matrix is a bit pragmatic, we can change the weights over time to kind of capture where we are in the cycle. It's very important that we always use the same weights for all the companies. So when you look at our target prices and the upside or downside to price, you can always make an informed decision that this company, based on the same valuation matrix, is worth this much, and this company is only worth this much, so it's higher upside in one than the other, and then investors can allocate capital efficiently. That's our method. Hopefully, it was in transparent.
Yeah. Okay. Any comments on today's developments in futures? 27% up and 12% up in Cape and Panamax.
I think I covered that earlier. So I think it's the sentiment also. It's improving, and Chinese New Year behind us.
Mm-hmm.
I see the top one is quite.
I was saving it.
Yeah. Okay. I can see it.
Yeah. Okay. So what do you think about the Joakim memes?
Yeah, I love them. I think it's so fun. I feel honored that people are taking the time to make those time and effort to make those. No, just a lot of fun.
Yeah. All right. So we have this one. Probably IMO 2020. Might IMO 2020 compliance still have the ability to upend bulker markets, or is that permanently passed?
Yeah. Okay. So I never kind of thought it would upend the market, but I feel it's coming back. So what we obviously started the year with high premiums, and all the scrubber owners were really happy, and then we had the collapse in oil prices, and that kind of oil prices correlates more with the low sulfur fuel oils than the high sulfur ones. And then the premium shrunk, and suddenly it was not, or the payback time in the scrubber investment was not very good. This is moving back now with oil prices moving up. So I think the case is still there. It's becoming more and more attractive to install them again. And I mean, especially looking at, I would say Capes now and VLCCs, it's you don't have that big alternative cost by off-hire, so it makes a lot of sense going into dry dock now. And when you're already there and you see the futures curve on the low sulfur fuel oils, you might want to have a balanced portfolio approach and install scrubbers on some of your vessels. So I think it's coming back, but I always believe that you will still trade old girls as long as the rates are good enough. A little bit more scrapping, yes, but nothing material. I would say this is not kind of the game changer. The game changer is the low fleet growth or the low order book.
Okay. You estimate 2020 brokers dividend for 1Q at 6 cents. They declared 13 cents for January. Do you have comments on the potential going forward?
Okay, so for Q1, yeah, I don't have the numbers in my head, but obviously this is due to I'm almost certain it's due to, in our reports we have cash flows for the quarter, which is the dollar amount paid in the quarter, but declaration is almost often the month before. So then you will have one month kind of a skewness between the declaration and the cash flow. So that is likely the reason if you see any discrepancies behind one table or the other. And what was the last part of the question? Comments on the potential going forward? Yeah, I mean it's a massive potential going forward. I don't know if you can share just briefly maybe I can do it. No, if you can share the presentation again in the appendix, we have or the pair table in the just a few slides before this one. There, okay. Oh, okay. Sorry, I didn't add it here. I'll go to the appendix. I think I have it there. Okay, so here you see the dividend yield to the far right. So for 2020, we have 15% dividend yield for 2021 and 35% for 2022. So that's compared to the others best in class. You shouldn't pay attention to bulk.no. It's good bulk. It's OTC. It's the price there is off the chart. So just the point here is that we believe 2020 bulkers will be the best yield play in the years to come.
Yeah. Okay. What are the greatest risks to your positive forecast?
That's always a good question. I mean, maybe we can get the picture up again. Thank you. I mean, so with 40% of all dry bulk seaborne trade ending up in China. China is obviously the key player here. So if China for some reason reduces their imports, that's not gonna be good. So is that something they potentially can do? We have seen the coal story. It's a bit shaky, and I think back in 2015, they drew back significantly on their coal imports. And the reason they can adjust so much imports without having any impacts on the logistics or an infrastructure on I would say commodity logistics domestically in China is because I think 2%, I think this number of all Chinese coal consumption is imported. So, and that number, I think overall it's in the 300s or 350 or something. Please check the report we have issued for the exact numbers. I think we have them in there. But the point is that if they reduce coal imports by 10%, that equates to 0.2% approximately of their consumption. And it's so easy for them to kind of just increase domestic production slightly. So the coal story is kind of where we have the least confidence. But that said, in our forecast, we also forecast for zero growth after 2022. So we have a recoup year now, and then next year I think we have 3 or 2% growth, and then zero growth. Behind that zero growth, we also have an expectation that Chinese authorities will still focus on cleaner air And one important driver to achieve that is to import more iron ore and coal, which is which has higher quality, so you can burn less to get the same amount of energy and steel output. So that's kind of, we expect consumption to go down, but imports to increase in terms of the consumption matrix. But I think that's kind of maybe the biggest risk going forward.
Okay, so this is kind of related. Thank you, Joakim. Very insightful presentation. Last time we saw high 5 to 6 figure spot rates in dry, we saw a massive influx of non-shipping capital enter the market and tonnage levels skyrocket. Do you think that will happen again?
It's not our base case, but I mean, with the order book at the level it is, so as you know, kind of the fleet utilization function, if you have spot rates on one axis and fleet utilization on the other one, sorry, reverse order, you kind of, when fleet utilization moves up towards 80, nothing happens, 82, nothing happens, and then suddenly you reach around 90 and it just go exponentially up. And when it's at 100, you have no idea where spot rates are going to be, because then it's completely different economics and dynamics. And to exemplify it, we saw VLGCs move to 100% a few months ago, and then our models, we can just throw them out the window, because what is determining how much is left for ship owners is pricing differentials, infrastructural bottlenecks. It's just all about economics, and that ship owners are able to capture 100% of any economics in the supply chain. I think that can happen over the next few years. I definitely do, but it's not something we could highlight as a base case. But in a high case scenario, with fleet growth of 1 to 2%, and that's transparent. You know, you can't change that over a period of 1.5 to 2 years. You have to live with it. And if demand then suddenly, if you have a positive demand shock, then yes, triple digits on capes easily. But again, it's not our base case, but we are moving into an environment where you could potentially see such moves.
Okay.
I think maybe one or two more.
Yeah. So perhaps this one. If China could import most of coal from Indonesia instead of Australia, what is the impact on the dry bulk business according to China ban importing coal from Australia?
Yeah. Briefly touched upon it, but to expect kind of when China doesn't take Australian coal, Australian coal, maybe the first few weeks you have a supply chain disruption, but then the coal always finds a new home, and that let's say South Korea imports an Australian coal cargo rather than taking an Indonesian one, and then Indonesian one goes to China. So it's basically net zero. You can have Colombian coal, which we were supposed to go to Oman or Middle East or somewhere, and then it's picked up by China, and then the Middle Eastern buyer is taking Australian cargo instead. So it's kind of fascinating to see how the capitalistic system works. It always kind of works itself out as long as it's not too regulated and too much politics. Of course, politics can play a big role in also where cargoes are routed. But the big thing right now is, I think, vessels tied up outside Chinese discharge ports. So I think it will not have too much impact either way.
Okay, final one. Maybe this one. Do you see an increasing amount of capital coming into dry bulk from institutional investors?
Yes, definitely. That's kind of what we see, and that's why we are so positive. And in my years as a shipping analyst, I remember last cycle, 2014, 15, everyone was super psyched. We were having meetings in New York and with all the big names and generalist guys, and not having kind of the deep knowledge of shipping. They were very optimistic. And, everything was fun, and then a lot of new buildings were ordered with delivery in 2016, and then the whole market collapsed, mainly due to the supply coming in, but there were also demand factors in 2016. So we kind of had a perfect storm, and it did not end well. So since then, coming to New York, for instance, talking to the big names, I remember I heard one guy told me, shipping. No, the last time someone came with shipping here, that guy he came to, he doesn't work here anymore, and I can't take shipping to my investment committee. They're just going to throw me out right away. So not a chance. But that is changing now. That's why we are so psyched. That's why we're so optimistic. Now we see this is changing. And one of the reasons I'm extra optimistic is because we haven't seen new build orders being placed at all. We always expect some new building orders to be placed. But I think if you look at our shipping quarterlies for the past 2 years or something, you will see our forecast for ordering is consistently overshooting actual orders. And that's the reason, and then you have deliveries, so the order book is just shrinking and shrinking. And I don't see that changing materialistic either, because yes, I think it will be more ordering. We have forecasted for increased level of ordering in concert with increased asset prices and earnings, obviously, better economics. But we have so much uncertainty on regulations, new technology. I think we will have an unusual ordering period in the next 2 or 3 years as well. So it's always hard to predict the next 3 or 4 years beyond the transparency of the current order book, and we always something changing on the demand side. But as of now, from where we are right now, I could easily see this cycle developing until the mid 2020. So slow and steady gains until 2025, and then back to one of the previous questions. If then we get a demand shock, a positive demand shock in that period, where you already are on 90% plus fleet utilization, boom.
Could be fun.
It's going to be fun.